I'm Rhonda Legge with ETF Guide TV. I've got some charts I want to share with you. We're going to take a look at markets from a couple of different angles, so let's get right to it. Beginning with the scariest month of the year, October. Welcome all. And you take a look at the CNN Fear Greed Index right now in fearful territory. And we've seen stock market volatility rise, and prices have come down a little bit. Nevertheless, if we take a look at market prices on a year-to-date basis, that's since the start of 2023, total world stocks, now this includes not just U.S. stocks, but also international and emerging markets as represented by ticker symbol VT, up nicely about 9.5%. And if you compare that to some of the other major asset classes, bonds not doing very well, BND down about 1%, and commodities are up actually just a nudge over 4%, doing relatively well. And then global real estate down about 5%. So as you can see here, compared to some of these other major asset classes, global stocks are doing pretty well. And so the fearfulness that investors have right now is pretty curious, I should say. Some of those sentiment readings aren't always precise in their accuracy, but nevertheless, we look at them. And if you look at that blue line here, that represents Bitcoin in USD versus the US dollar, or in dollar terms, and it's up just a nudge over 61%. So holding on to its gains, Bitcoin is, and for the most part, cryptos really since the start of the year have been very good performers. Now, if we take a look at the U.S. stock market by industry sector, and we slice up the S&P 500, which is a large cap yardstick of 500 companies, U.S.-based companies, and we take a look at them by industry groups, you'll see there's 6 up and 5 down since the start of the year. The top 3 among the top 6 performers are communication services, technology, and consumer discretionary. That's pretty much been the case all year long with these 3 sectors leading. At the very bottom are defensive industry sectors like utilities and consumer staples, and then, of course, you got real estate there. So those industry sectors, you got 2 of 3 that are sensitive to rising interest rates, and certainly that's can be explaining some of the weakness in terms of performance with real estate and utilities. Now, here's our weekly reminder that ETFs can and do outperform some of the best performing individual stocks. And if we take a look at the past 10 years, we've got Apple, one of the best performing single stocks in the market, gaining just over 1,000%. Yet, we've got 2 ETFs here that have gained more than double that amount. We've got TECL, which is up 2,706%. And then we've got TECL, which is up almost about double. I'm sorry, TQQQ, which is the NASDAQ 100 3X daily, up almost double Apple. Of course, these ETFs that I'm showing you here use leverage. So they leverage the performance on the upside. That can work against you in a down market, and you can see the volatility here of these triple X ETFs. A lot more volatile than Apple for sure. But if you take a look at this on a longer time horizon, there is outperformance to be had. That's the point I'm trying to make here. And of course, there's many other examples. We've highlighted Tesla, one of the best performing securities over the past 10 years, which has been easily outperformed by these same 2 ETFs. Now, if we take a look at the U.S. stock market by market size, so if we slice up the U.S. market by large, mid, and small cap, you'll see that the large caps, SPY, are outperforming the smaller stocks by a pretty significant margin. We've got S&P 500. This is a 1-year performance chart, up almost 20%. And over that same time frame, mid-cap stocks are just about flat. That's represented by, that's small cap stocks, IJR. That's the S&P 600, small cap 600, just about flat. And then MDY represents the S&P mid cap 400, which is ahead by about 7.5%. But nevertheless, my point here is that mid caps and small caps have been lagging behind large caps. And usually that's where you get the most growth over a longer period of time. You get it from those smaller companies. So those of you with a growth orientation in your portfolio, take note. This is an opportunity to maybe reweight your portfolio into some of these smaller companies, maybe take a little bit off the table from some of those large caps that may have become a larger portion of your portfolio. And then if you add up these three, S&P 500, S&P 600, and then S&P 400, you actually come up with something called the S&P 1500, which is actually the Standard & Poor's definition of the total U.S. stock market. That's their universe, 1,500 stocks. But that's your look at markets on a large, mid, and small cap basis. Now, let's go to something that Jamie Dimon had to say in the earnings report for JP Morgan Chase. Some interesting comments that he made, and we've highlighted some of them here. Some of the concerns about tight labor markets, as well as extremely high government debt levels with the largest peacetime fiscal deficits ever. And we've pointed that out on this channel many times, and I hope you know that the end game is going to be dramatically higher tax rates for all U.S. income taxpayers. That's where this is heading. And so, as I've been trying to emphasize in your retirement planning, it's so crucial to have proper tax positioning of your assets and getting more money into the tax-free zone, getting it out of the taxable bucket, out of the tax-deferred bucket, which are most exposed to increasing tax rates, get it into the tax-free zone. That's where your money's sheltered from the threat of higher taxes. More on that in a second. I have a new book that just came out called Portfolio Architecture. It talks all about proper tax positioning. But keep reading here what Jamie Dimon's comments have to say. He's talking about war in the Ukraine, compounded by, obviously there's war right now happening in Israel and Gaza. That's also complicating matters. And then what I've highlighted here, this may be the most dangerous time the world has seen in decades. So I'm not a big fan of Jamie Dimon, quite frankly. I mean, I'll never forget what he said 5 years ago, that people that buy Bitcoin are going to pay for that. And that's when Bitcoin was around $5,000 a coin. And we've gone 4x on that? 4 or 5x? So he was pretty wrong on cryptocurrencies. And nevertheless, I think he's right on with regard to his comments and his wearing his economic hat, and that we are definitely in a very dangerous time frame. And now more than ever, it's so important for investors to incorporate safety into their investment portfolio. So this is an excerpt from my new book called Portfolio Architecture, a Handbook for Investors. And this is really a framework. This is what I call the 3 cornerstones of an architecturally sound investment portfolio. You've got number 1 is a safety-first approach. You start with having a risk-free money. That's your margin of safety cushion. That's number 1. Number 2 is your core portfolio, and then number 3 is your non-core portfolio. Just focusing on the safety portion, you've got 3 attributes for this particular bucket, which is risk-free money. That means you're preserving your capital. There's zero volatility of the assets held inside the margin of safety bucket. There's no possibility of any losses, and you also have liquidity. It's fundamental that you use the right types of assets for your margin of safety bucket. Bonds do not qualify as a margin of safety asset. Gold does not qualify as a margin of safety asset. Bitcoin does not qualify as a margin of safety asset. Treasury bonds do not qualify as margin of safety assets. Money market funds that are uninsured do not qualify as margin of safety assets. So it's so crucial that you have a fundamental understanding, and so many out there don't have a real grasp, and they're trying to use assets that are not designed to protect their capital. They're trying to use that for margin of safety assets. A perfect example would be the 60-40 portfolios, which that 40, which is supposed to represent bonds, right now with rising interest rates, that has not been a source of protection for investors. Bonds have been losing value. And so it's so crucial to use the right types of assets for your margin of safety bucket. That's your anchor. And that takes us to my new ebook and audiobook. I'm so excited about this, Portfolio Architecture. I've got a link below in the description section. I want all of you to get your copy today. It's going to teach you how to build an architecturally sound investment portfolio. If you've already built an investment portfolio, and many of those of you watching have already done this, well, maybe your portfolio needs to be rebuilt. Maybe it needs to be refurbished. Maybe it needs a remodel. Maybe there's things that are in your portfolio that are happening that you're not even aware of. Maybe you have some concerns. Well, this is going to teach you how to fix all of that. Suitable assets for your core portfolio, your non-core, suitable assets for your margin of safety bucket, and then, of course, proper tax positioning with dollar limits for each tax container. You'll get that. Also, there's 27 model ETF portfolios for investors of all ages, from starting at age 10 all the way to 100. And then lots of other good stuff in that book that will help you instill confidence in your investment choices and then simplify and improve your overall investment process. So Portfolio Architecture, a handbook of investors. This is my new ebook and audiobook. It comes together, so you can't buy them separate. And again, the link is posted below. Also, that margin of safety tool that I built, this is one of the reasons that I have been working so hard, helping you to calculate what portion of your overall portfolio should be allocated to safety, and then helping you to implement that the proper way. You can calculate it, but then you can also implement it the wrong way. Most investors don't do either. And so this tool will help get you on the right path to portfolio protection. So that does it for today's episode. I hope you've enjoyed the show. We've got a new episode of ETF Battles coming up next week. We've also got First Look ETF, another episode planned for you. So stay on the watch for those upcoming episodes. I'm Ron DeLegge with ETF Guide TV. Be sure to hit the subscribe button and also the description section below to check out my fewer resources. Again, I've got links to the new book, Portfolio Architecture, along with the Margin of Safety tool. These are all things that will prepare you for the uncertainty, the volatility, and the things that yet lie ahead. Best of success to all of you. We'll see you soon.